How to calculate yield on cost in real estate investments. Most investors focus on the cap rate, but they're really missing out on the most important metric. It's yield on cost. This one number can tell you if you are making a good investment or just spinning your wheels and wasting your time. What if I told you that the deal that you thought was a home run was actually not performing? Yield on cost actually tells you the truth about a property before and after you make the improvements. Do you want to know how to measure the actual profitability of a real estate investment? In this video, I'm going to show you how to calculate yield on cost, which will help you make great commercial real estate and residential real estate investment decisions. By the end of this video, you'll know exactly how to calculate yield on cost, why it's more important than the cap rate, and how to use it to make better real estate investment decisions. What is yield on cost? Well, it's the key to seeing if real estate is going to be profitable and meet your investment goals. The formula is yield on cost, which is summarized as YOC, equals stabilized net operating income divided by your total cost basis or purchase price plus improvements. This measures the total returns of the project after you've made the improvements and after some time has gone by for the stabilization. This number helps you compare your project level returns versus what market cap rates are. So what does stabilized really mean in real estate? A property stabilized means it's hit its target occupancy numbers. This is typically between 85 and 95% occupancy, depending on if it's storage or multifamily or industrial. Once you've hit that occupancy number, the property is considered stabilized. For value add properties, it means that you've made all the improvements and you have increased the occupancy, and at that time, the property would be considered stabilized as well. The timeline is really about your business plan. So it's typically 12 months on the minimum, up to 36 months on the maximum by the time that you've made your improvements or you've stabilized the rents, getting occupancy to the highest level of 85 to 95%. That would be the timeline of the stabilization. So why do we use yield on cost instead of cap rate? Well, cap rate can be misleading. You see, the cap rates only look at the current income and it doesn't consider or account for the future potential revenue of the property. Plus, yield on cost factors in all the improvements it's going to take to get the property to its stabilization. Cap rate doesn't consider this. Now, cap rate is a good indication of how the property performs at the time that you buy it, but yield on cost is a better indication about how the property performs after you've executed on the business plan. Yield on cost is just a more accurate measure of what success looks like. So, how do you calculate yield on cost? Here's the step-by-step formula. Step 1, determine your stabilized net operating income. Step 2, add up all your costs when owning and operating the property. The purchase price, the closing fees, the renovation costs, or any other fees that are needed to acquire and improve the property. Step 3, divide the stabilized net operating income divided by the total project cost. Example, if your total stabilized net operating income is $100,000 and your total project cost is $1 million after you acquired the property plus made the improvements, your stabilized yield on cost is 10%, $100,000 divided by the $1 million. Comparing yield on cost to market cap rates. If your yield on cost is higher than market cap rates, then you created value in the property. If your yield on cost is lower than market cap rates, then the investment's probably not worth it. An example is if market cap rates are at 6%, yet you buy a property, make the improvements, stabilize the rents, and you get the yield on cost to 8%, you then created value. Here is the go, not go test for real estate investments. If yield on cost is too close or lower than the cap rate, it is a no-go. Always calculate this number, yield on cost, when you're doing a value add project. This is the number one metric we use here at Patriot, and I suggest all investors in commercial real estate or any real estate use to determine the success of a potential project. Smart investors use this number to help avoid overpaying. Where you can get burned on this is if there's too many improvements in the property, increasing your cost basis, and you can't raise the rents high enough to cover them. That way you'll know my yield on cost is not worth all these improvements that I'm adding to the property. You may be getting a good deal on the cap rate, but if you have to put too many improvements in, that's going to lower your yield on cost, which it might actually even lower the return or the cap rate in time. So focus on this number, and this will help you be successful as a real estate investor. So a quick story about why cap rate can be misleading. When I started out in my career, I was very low on funds and I was looking for value-add investments. I was looking for mobile home parks and I found a nice one in Iowa, but when I showed up, it needed a lot of work. It had a challenging tenant base. There was quite a few sex offenders in there, a lot of violence, a lot of damaged homes and debris everywhere. But the cap rate was a 13 cap, and on the surface, I was hooked. I thought, wow, what a great return when market cap rates were typically 7 or 8. I learned my lesson. After I came in and improved all of the infrastructure, the water, sewer, power, improved a lot of the homes, cleaning up the debris, and also the cost of getting all the tenants out of the homes that weren't paying. Plus there was some apartments there that I had to renovate and improve. I added up all my costs on top of the cost of the purchase price of the mobile home park, and that 13 cap ended up turning into less than a 7 cap because I put so much money back into the property, yet I wasn't able to increase the revenue. So keep that as a lesson, that cap rate isn't always the most important metric. You need to know, what are you going to do for the improvements? How much is it going to cost? How much time is it going to take? And that's going to give you a clear metric of yield on cost, and then you can compare it to the cap rate. In my case, a 13 cap on acquisition looked nice, but after I had to stabilize the property and improve it, it was a 7. So I lost money on that deal. That is not what you want to do. And I couldn't not improve the property. I had the town on me, I had the tenants on me. It was my responsibility to fulfill the business plan, and I couldn't walk away from it. So that is a lesson that I learned. Yield on cost is a much better metric than the cap rate. If you want to maximize your real estate returns, then check out this free guide. I created the Essential Guide to Passive Real Estate Investing. I took 20 years of what I know in real estate and put them in this guide to help investors like you understand the secrets of partnerships, funds, and syndications. As you use this guide, it'll have a checklist so you can be sure that you understand what's going on with your passive investment. As passive investors, it's key that we have transparency and alignment with our investment partner. So click on the link in the description below. I'd love to share this with you, and feel free to call us at Patriot if you have any questions.